Canadians beware. BMO just dropped a chilling financial warning. As Canada's spring housing season comes to a close, financial institutions are warning of rough waters ahead. Douglas Porter, chief economist at BMO, recently sounded the alarm on what he sees as a prolonged real estate downturn. While home sales have seen a modest uptick this spring, it's not enough to reverse the broader slowdown. The tone has shifted decisively. Buyers are cautious, bidding wars are rare, and financial institutions are more conservative. Porter's comments may not have the weight of Canada's biggest banks like RBC or TD, but BMO's influence in the market is still significant, and when it warns of a bear market, people take notice. One of the biggest issues is how market conditions are being portrayed. Almost all the dire headlines about falling home prices rely on comparisons to February 2022, the absolute peak of the housing frenzy. But this was a very brief, extraordinary spike, not a stable high point. Few Canadians actually bought during that peak. Most either entered the market before the madness or stayed out entirely to avoid the chaos. So when analysts say prices are down 17%, they're measuring from a distorted high that doesn't reflect the broader homeownership experience. The people truly feeling the pain are those who bought at the top of the market, especially speculators. Many of them invested in pre-construction downtown condos, banking on endless growth. But with rising interest rates, tighter lending rules, and softer demand in urban cores, these units have lost value. Some investors are now underwater on purchases that haven't even closed yet. Unlike families who bought to live in their homes and plan to stay long-term, speculators bet on short-term gains and are now stuck with declining assets and higher carrying costs. Meanwhile, suburban and family-oriented housing markets are holding up much better. Detached homes, townhouses, and semis in outer urban areas are far less volatile. These are not investor-driven markets, and supply remains tight due to limited new construction. Families looking for stability are still active in these regions, even if they're moving more cautiously. Unlike city condo markets, these areas were never the site of speculative overbuilding. Demand remains, especially from growing families and second-time buyers who are waiting for interest rates to stabilize. What's really dragging the market now isn't lack of interest, it's the changing lending environment. Risk departments at Canada's major banks have clamped down hard. It's harder than ever to get a mortgage approved, especially for investors. Requirements are stricter, down payments must be larger, and many would-be buyers are now being turned away. This doesn't reflect a collapse in market fundamentals, it's a shift in risk tolerance from financial institutions. And as a result, market activity is slowing even in areas with genuine demand. Fueling the uncertainty is the media. Headlines highlighting massive price drops create fear, especially when they continue referencing the peak of February 2022. These comparisons distort the market's reality and trigger panic in potential buyers. It's like saying a stock has crashed because it's down from a record high, while ignoring long-term performance. These narratives not only discourage new buyers but also push existing homeowners into anxiety, further freezing the market. The panic becomes self-reinforcing, slowing sales even more. Politically, the housing crisis has become a central issue. Prime Minister Mark Carney, who recently replaced Justin Trudeau after winning the April 2025 snap election, is now under intense pressure to act. Carney's reputation as a former Bank of Canada and Bank of England governor raised expectations that he would bring economic stability. But so far, his government has been slow to offer bold housing solutions, and voters are growing impatient. With affordability eroding and real incomes under pressure, Canadians are looking for leadership, not just analysis. One of Carney's key promises was middle-class tax relief, with income tax cuts expected to roll out before July 1st. These cuts aim to offer modest savings for dual-income households and provide some breathing room. But critics argue they won't be enough to offset rising mortgage costs, inflation, and the impact of higher interest rates. Supporters say it's a positive first step, but much more will be needed to rebuild confidence in the housing market and the broader economy. The true test will be whether this measure can move sentiment or simply get lost in growing frustration. Carney's legislative agenda also includes a push to break down interprovincial trade barriers and accelerate infrastructure development. These policies are being framed as efforts to spur growth and remove red tape, particularly in housing and energy. But they've raised concerns among indigenous leaders and provincial premiers who fear rushed legislation could bypass key consultation processes. Balancing economic ambition with proper engagement will be a crucial challenge if Carney wants to maintain national unity and avoid alienating core regions. The Bank of Canada, under Governor Tiff Macklem, also remains under scrutiny. Interest rates are still elevated, and while inflation has slowed, rate cuts remain on hold until underlying pressures cool further. Canadians with upcoming mortgage renewals are bracing for financial strain as monthly payments jump. Any significant relief will likely depend on a rate cut, something that many now hope will happen before the end of the year. Without that easing, housing demand could remain sluggish, particularly among first-time buyers and those who are already financially stretched. Despite all the turbulence, this isn't a market in free fall. What's happening is a natural recalibration. Prices are adjusting from unsustainable highs, not collapsing into oblivion. In fact, even current prices, though down from the peak, are still well above pre-pandemic levels in most markets. The fundamentals still matter. Canada continues to experience high immigration, limited housing supply, and persistent demand in key segments. Once interest rates settle and confidence returns, the market is likely to stabilize and begin recovering, albeit more slowly than in the past. The key for Canadians is to stay informed and rational. Don't let headlines based on outlier data points dictate your perception of the housing market. Real estate is cyclical, and while we're currently in a cooling phase, the long-term outlook is not apocalyptic. Focus on real needs, solid financial planning, and avoid making decisions based solely on fear. Whether you're a homeowner, a prospective buyer, or an investor, strategic thinking is your best asset in uncertain times. In short, the warning from BMO should be taken seriously, but not catastrophically. The market is not collapsing, it's adjusting. The real danger isn't falling prices, it's panicked overreaction. Lending is tight, speculation is unwinding, and political action is slow, but the foundation of Canadian housing remains intact. This is a moment for vigilance, not despair. Stay calm, stay informed, and prepare for the next chapter of Canada's ever-evolving real estate story.